The U.S. tax code is famously complex, but if you are a Turkish American, whether working in tech on an H-1B visa or holding dual citizenship, you are walking through a labyrinth rigged with international tripwires. The U.S. system offers incredibly powerful tax deductions to help you build wealth. To access them, however, you have to accept a massive administrative burden, the strict legal requirement to report your global assets to the IRS. Navigating that trade-off is exactly why Arkin Ledger authored the ABD Vergi, the definitive U.S. tax guide built specifically for the cross-border challenges faced by Turkish Americans. When it comes to international tax law, the IRS does not accept ignorance as an excuse. Protecting the wealth you build requires a rigorous approach to compliance. Before you can optimize a single dollar of your taxes, you have to definitively establish your U.S. tax residency status. This flowchart illustrates exactly how residency is triggered. If you are a U.S. citizen, if you obtain a green card, or if you simply spend enough days in the country to pass the substantial presence test, you trigger the yes path. Hitting yes mandates reporting your global income to the IRS. It also activates strict rules like FBAR and FATCA, requiring you to disclose foreign bank accounts and financial assets. Because the rules apply differently depending on your income and assets, we are going to evaluate the best strategies through the specific scenarios of 3 typical Turkish American taxpayer profiles. Your specific residency status and financial footprint dictate which tax-saving tools you can deploy and which compliance traps you need to avoid. Profile 1 is the high-earning W-2 professional. Think of a software engineer or tech executive working in major U.S. tech hubs like San Francisco. For this profile, the salary is high, which means the marginal tax rate is high. The primary optimization goal here is aggressively lowering adjusted gross income, or AGI. By maximizing contributions to a traditional 401k and a health savings account, a W-2 earner immediately drops their taxable income into a lower bracket, saving thousands of dollars on this year's tax bill. This split screen compares that immediate benefit against the alternative. On the left, you reduce your AGI today. On the right is the Roth trade-off. You pay those high marginal taxes now, but you secure tax-free growth and withdrawals in retirement. But high earners frequently walk right into a critical compliance trap. They meticulously plan their 401k, but forget to file an FBAR for an old bank account their parents opened for them back in Turkey. If you are a W-2 professional, aggressive domestic retirement optimization works, but it has to be paired with accurate tracking of even minor foreign assets. Profile 2 is the cross-border earner. This is a dual resident who collects rental income, earns stock dividends on the Borsa Istanbul, or maintains active business interests in Turkey. The primary fear for this group is paying taxes twice on the exact same dollar, once to the Turkish government and again to the IRS. Many assume the U.S.-Turkey tax treaty automatically protects them. It does not. The treaty includes a savings clause that legally permits the U.S. to tax its citizens and residents globally, entirely overriding the treaty's exemptions for most income. This diagram shows the actual solution, Form 1116, the foreign tax credit. When you input the taxes you have already paid in Turkey, this mechanism calculates a dollar-for-dollar reduction against what you owe the IRS. The tax treaty is not a shield that deploys on its own. You have to proactively calculate and claim the foreign tax credit on your return to defend your wealth from double taxation. Profile 3 is the Turkish business owner. This includes entrepreneurs launching U.S. LLCs or individuals who hold a 10% or greater stake in an existing Turkish company. Owning foreign corporate assets or structuring new U.S. entities triggers the heaviest reporting requirements found in the U.S. tax code. If you own 10% of a foreign corporation, you must file Form 5471. It is a highly complex, mandatory disclosure that must be filed every year, even if the Turkish business doesn't make a single lira in profit. This bar chart outlines the base financial penalties for missing these filings. Failing to file Form 5471 or an FBAR starts with a $10,000 penalty per form per year. And under the new Corporate Transparency Act, failing to report beneficial ownership information for a U.S. LLC results in a $500 civil penalty that stacks up for every single day you are late. For cross-border business owners, attempting to handle this paperwork alone is a severe financial risk. Absorbing the cost of expert compliance is the only viable insurance policy against business-ending IRS penalties. Cross-border tax planning is a year-round defensive strategy. It is not a historical data entry task you scramble to complete every April. This matrix connects our 3 taxpayer profiles directly to the tools they should use and the risks they manage. The W-2 earner focuses on AGI reduction while tracking accounts for FBAR. The cross-border earner uses the foreign tax credit to eliminate double taxation. And the business owner must prioritize strict reporting, specifically Form 5471 for foreign companies and FinCEN BOI reporting for domestic LLCs. Standard tax software is not programmed to handle the nuances of treaties, foreign tax credits, and dual country asset reporting. Relying on it leaves you exposed. To safely implement these strategies, consult the experts who literally wrote the book on it. You can reach Arc and Ledger Accounting at their headquarters in Culver City or connect with them online at arcandledger.com. Ultimately, high earnings cannot protect your wealth on their own. To secure your financial future, you must align every global asset with airtight U.S. compliance.